Bitcoin ETF 6-day outflow streak pushes 2026 to brink of net negative US spot. Bitcoin ETFs have now posted 6 consecutive sessions of net outflows, dragging the running 2026 inflow total down to roughly $536 million, according to a Cointelegraph tally published May 25th. That figure is small enough that another bad week could leave the entire 2026 vintage net negative, an outcome that looked unimaginable when the same products absorbed tens of billions across 2024 and 2025. Bitcoin itself was trading at $77,241 as of May 25th, up 0.6% on the day, but flat across the prior 7 sessions. The ETF bleed is happening even as spot price holds a relatively narrow range, which makes the flow story harder to dismiss as a mechanical reaction to a price crash. 6 sessions of red, no recovery day. The 6-day streak is the most sustained outflow run since the early February dislocation that followed the Fed minutes shift. There has not been a single positive print since the streak began, and the cumulative drawdown over those 6 sessions has been large enough on its own to pull the year-to-date total from comfortably positive territory down to the current $536 million. For context, through the same week last year, 2025 cumulative inflows were running in the multi-billion-dollar range. The 2026 vintage is on track to look nothing like that. $536 million now covers the whole year. The math is uncomfortable. Roughly $500 million of net new money over 5 months works out to less than $110 million a month on average, and that average is being dragged down further with every additional outflow session. Compare that to peak months in early 2025 when single days could clear $1 billion in net subscriptions. If the next 5 trading sessions deliver outflows at anything near the recent pace, the year flips net negative outright. That would be a first, since the products launched in January 2024 and would invert a core piece of the institutional adoption narrative that supported price action through the bull cycle. Macro pressure is doing most of the damage. The flow weakness lines up with a broader macro repricing. Treasury yields back near 5% have given allocators a credible alternative to risk assets. Fed minutes flip the rate cut trade into a hike risk problem, and apparent demand for spot Bitcoin has collapsed to 147,000 BTC, the worst reading since late 2025. None of those data points individually explains a 6-day outflow run, but together they describe an environment where the marginal institutional buyer has paused. ETFs are the cleanest read on that buyer because subscriptions and redemptions clear at the close every day. There is no narrative haze around the number. Concentration risk inside the streak. One overlooked detail in the daily prints is how concentrated the outflows have become. The largest single product, BlackRock's IBIT, has continued to absorb intermittent inflows even on net negative days, meaning the redemption pressure is heavily concentrated in the smaller and higher fee issuers. That dynamic narrows the field of products that are still functioning as accumulation vehicles for institutions and widens the gap between the leading issuer and everyone else. It also means a flow reversal does not require all 11 products to turn positive at once. A single multi-$100 million IBIT print is enough to swing the daily aggregate green, which is part of why the streak feels precarious rather than structural. Implications for spot holders. For holders, the ETF flow channel matters, because it is the cleanest visible source of structural buying. A net negative year from spot ETFs does not preclude price upside, but it removes one of the 3 legs that the post-launch thesis rested on, alongside strategies accumulation and corporate treasury adoption. With Saylor signaling strategy could become a seller before year-end, and Bitmine adding 126 mators of ETH instead of BTC, the structural bid is thinner than it was a quarter ago. That does not mean a snap rally is impossible. It does mean the burden of proof has shifted. Rallies from here need to be carried by something other than passive ETF subscription growth.